What if I told you that most people have completely backwards ideas about dividend investing? What if the common wisdom about living off dividends from $1 million is not just wrong, but dangerously misleading? Here's something that might shock you. While everyone's chasing those flashy dividend yields promising financial freedom, the reality of dividend income from $1 million will probably surprise you more than you think. My name is Nick, and I help people understand the real math behind dividend investing without the fairy tales or get-rich-quick fantasies. If you're serious about building actual wealth through dividends and want to know what $1 million portfolio really delivers, make sure to subscribe to the channel and hit the like button if this information helps you see through the marketing hype. Let me start with a question that most dividend enthusiasts refuse to ask honestly. When you see those YouTube thumbnails screaming about passive income and financial freedom, what number do you actually picture in your head? Most people imagine something like $50,000, maybe even $100,000 flowing into their bank account every year from dividends alone. They're dreaming of quitting their jobs, traveling the world, or at least covering all their living expenses without touching the principal. But here's where reality crashes into fantasy, like a freight train hitting a paper wall. The average dividend yield of the S&P 500 sits at roughly 1.2%. Yes, you heard that correctly. 1.2%. That means your $1 million portfolio would generate about $12,000 in annual dividend income before taxes. $12,000. That's barely enough to cover a few months of expenses for most people, let alone fund some luxurious retirement lifestyle. Now, before you start thinking, I'm here to crush your dividend dreams entirely, stick with me, because this story gets much more interesting. The surprising part isn't just how little the average yield provides. The surprising part is understanding why this happens and what it actually means for your wealth building strategy. Most investors make a critical error when they start hunting for dividend income. They see a stock yielding 8% or 10% and think they've discovered buried treasure. Their eyes light up with dollar signs as they calculate how that high yield would transform their portfolio returns. But here's something the high yield dividend chasers don't want to admit. Yet those sky high yields often signal danger, not opportunity. When you see a dividend yield above 6 or 7%, you're usually looking at one of three scenarios. Either the company is in serious financial trouble and the market is pricing in a dividend cut, the stock price has collapsed due to fundamental business problems, or you're dealing with a special situation that probably won't last. It's like finding a designer handbag at a garage sale. Sure, it might be authentic and a great deal, but there's probably a reason it's priced so low. Let me give you a perfect example of how this plays out in the real world. Altria, the tobacco giant, currently offers a dividend yield of nearly 10%. On paper, that looks incredible. Invest $100,000 and collect almost $10,000 in annual dividends. But here's the catch that most dividend hunters conveniently ignore. Altria's business is literally shrinking every year as fewer people smoke cigarettes. The company has been using debt and cost-cutting to maintain those dividend payments, but that's not a sustainable long-term strategy. This brings us to one of the most important concepts in dividend investing that nobody talks about openly. Dividend yield and dividend safety operate on an inverse relationship most of the time. The higher the yield, the more likely that dividend faces future cuts. It's like dating someone who seems too good to be true. They probably are. So if chasing high yields is a trap and the broad market only yields about 1%, where does that leave serious dividend investors? This is where the story takes an interesting turn because there's actually a middle ground that most people completely overlook. Consider the Schwab US Dividend Equity ETF, known by its ticker SSCHD. This fund focuses on high-quality dividend-paying companies with strong fundamentals and consistent payout histories. The current yield sits 3.4%, which means that $1 million portfolio would generate about $34,000 annually. That's nearly triple what you'd get from the broad market, and it comes from companies with much more sustainable business models than those high yield traps. But even $34,000 might not be the retirement paradise you were imagining. According to recent data from the Bureau of Labor Statistics, the average household needs about $66,000 annually to cover basic expenses. So even with a carefully constructed dividend portfolio, you're still falling short of a comfortable lifestyle by a significant margin. This is where most dividend investing advice goes completely off the rails. The financial media loves to showcase these cherry-picked examples of dividend portfolios generating massive income streams, but they rarely show you the full picture. They'll highlight someone collecting $50,000 or $60,000 in annual dividends, but they won't mention that this person probably has a portfolio worth well over $2 million, or that they're reinvesting a significant portion of those dividends rather than spending them. Here's another surprising reality about dividend investing that most people discover too late. The tax implications can be brutal if you're not careful about account placement. Dividends and taxable brokerage accounts create immediate tax obligations, unlike growth stocks that only generate taxes when you sell. For someone in a higher tax bracket, a significant portion of that dividend income disappears to Uncle Sam before it ever reaches your bank account. Let's talk about what this means practically. If you're collecting $34,000 in dividends from that SCHD portfolio and you're in a 25% tax bracket, you're really only keeping about $25,500 after taxes. Suddenly, that $1 million dividend portfolio is looking less impressive by the minute. But here's where the story gets even more interesting, because I haven't told you about the most surprising aspect of dividend investing yet. The companies that pay the highest sustainable dividends often aren't the ones you'd expect. Some of the most reliable dividend payers are boring, unsexy businesses that most investors completely ignore. Take Federal Realty Investment Trust, for example. This company owns shopping centers in affluent areas, and it's been increasing its dividend for over 50 consecutive years. Yes, you read that correctly. 50 years of consecutive dividend increases, including through multiple recessions, market crashes, and economic upheavals. The current yield sits around 4%, but the reliability factor is off the charts compared to those flashy high yielders that grab all the attention. This brings us to one of the most crucial concepts in dividend investing that separates successful income investors from those who chase shiny objects. Dividend growth often matters more than current dividend yield. A company paying 3% today but increasing that dividend by 8% annually will eventually outpace a company paying 6% with no growth. It's the difference between compound interest working for you versus against you. The math on this is actually stunning when you run the numbers over long time periods. A stock yielding 3% with 8% annual dividend growth will double its annual payout in about 9 years. After 20 years, that same stock is effectively yielding over 14% on your original investment. Meanwhile, the high-yield stock that caught your attention initially might have cut its dividend twice and be yielding less than when you bought it. This is why dividend aristocrats, companies that have increased their dividends for at least 25 consecutive years, often form the backbone of serious dividend portfolios. These companies have proven they can grow their payouts through various economic cycles, market conditions, and business challenges. They're the boring, reliable workhorses that build real wealth over time rather than providing exciting stories for social media posts. But even understanding dividend growth doesn't solve the fundamental challenge we started with. How do you actually generate meaningful income from $1 million portfolio without taking excessive risks or falling into high-yield traps? This question becomes even more complex when you factor in inflation, changing market conditions, and the reality that most people need their dividend income to grow over time rather than remain static. The answer involves a combination of strategies that most dividend content creators never discuss honestly, and it requires understanding some uncomfortable truths about what dividend investing can and cannot accomplish in today's market environment. The reality is that most successful dividend investors use what I call the hybrid approach, but you'll never hear this strategy discussed in those clickbait dividend videos because it doesn't sound nearly as exciting as promising instant passive income. This approach combines dividend paying stocks with dividend growth investing and strategic reinvestment in a way that actually works in the real world rather than just on spreadsheets. Here's how this actually plays out with real numbers that might surprise you. Instead of putting that entire $1 million into dividend stocks immediately, experienced investors often start with a foundation of quality dividend growth companies, then layer in different types of income producing assets over time. They might allocate $600,000 to dividend aristocrats and high quality dividend ETFs, $200,000 to REITs for diversification and higher yields, and keep the remaining $200,000 in growth investments that don't pay dividends at all. I know what you're thinking. Why would someone seeking dividend income invest in companies that don't pay dividends? This seems counterintuitive, but it's actually brilliant when you understand the psychology of sustainable income investing. Those growth investments provide the capital appreciation that allows you to periodically rebalance and increase your dividend producing positions without touching your income stream. It's like having a savings account that grows automatically and feeds your dividend machine. Let's run through a realistic example of how this might work. Your $600,000 in dividend-focused investments yields an average of 3.5%, generating $21,000 annually. Your $200,000 in REITs yields about 5.5%, adding another $11,000. So far, you're collecting $32,000 in dividends, which is still short of that $66,000 lifestyle target we discussed earlier. But here's where the strategy gets interesting. Those growth investments that don't pay dividends might appreciate by 8% annually on average. That's $16,000 in capital gains on your $200,000 allocation. Now, you don't have to sell those growth stocks to benefit from this appreciation. Instead, you can use the increased portfolio value to justify taking out a small loan against your holdings, or you can strategically harvest some gains during tax loss season to fund additional dividend stock purchases. This creates what sophisticated investors call a self-reinforcing cycle. Your dividend income provides immediate cash flow, your growth investments provide capital appreciation, and you periodically convert some of that appreciation into additional dividend-producing assets. Over time, your dividend income grows not just from the companies increasing their payouts, but from your ability to buy more dividend-paying shares without reducing your standard of living. The math on this becomes truly compelling over longer time periods. After 10 years of executing this strategy, that original $1 million portfolio might be worth $1.8 million, but now it's generating $55,000 in annual dividend income instead of the original $32,000. You've nearly doubled your dividend income while growing your net worth substantially, and you did it without chasing those dangerous high-yield stocks that probably would have cut their dividends multiple times during the same period. But there's another surprising element to successful dividend investing that most people discover only after making expensive mistakes. The timing of when you start collecting dividends matters enormously, and it has nothing to do with market timing or finding the perfect entry point. It has everything to do with your personal financial situation and tax planning. Most people approach dividend investing backwards. They accumulate dividend-paying stocks in their taxable accounts while they're still working and earning high incomes, then wonder why their tax bills are so painful. Meanwhile, their tax-advantaged retirement accounts are filled with growth stocks that don't generate any current income. This is exactly opposite of what makes sense from a tax efficiency standpoint. The smarter approach involves building your dividend portfolio primarily inside tax-advantaged accounts like 401ks and IRAs during your high-earning years while holding growth investments in your taxable accounts. This way, you avoid the immediate tax hit on dividend income when you're in your highest tax brackets, and you can take advantage of more favorable capital gains treatment on your growth investments when you eventually sell them. Then, as you approach retirement and your earned income drops, you can start shifting more dividend-focused investments into your taxable accounts where the tax impact will be lower. It's like playing three-dimensional chess with a tax code, but the savings can be substantial over time. Here's something else that might surprise you about dividend investing. The best dividend portfolios often include companies you've never heard of, and they definitely don't include many of the household names that dominate dividend stock lists on financial websites. These hidden gems are typically boring businesses with predictable cash flows, strong competitive advantages, and management teams that prioritize shareholder returns over flashy growth initiatives. Consider a company like Waste Management, which literally makes money from garbage. Not exactly the sexiest business model, but they've been increasing their dividend for nearly 20 years because people and businesses always generate trash regardless of economic conditions. Or look at automatic data processing, which handles payroll services for other companies. Again, not thrilling, but employees always need to get paid, making this an incredibly stable revenue stream. These types of companies form the backbone of serious dividend portfolios because they operate in industries that are essentially recession-proof. People might cut back on dining out or luxury purchases during tough economic times, but they're not going to stop generating garbage or paying their employees. This business model stability translates directly into dividend safety, which should be your primary concern when building an income-focused portfolio. The surprising truth is that many of the most reliable dividend payers are companies that solve mundane problems for other businesses rather than selling exciting products to consumers. They're the financial equivalent of plumbing. Nobody thinks about it until it breaks, but it's absolutely essential for everything else to function properly. This brings us to one of the most counterintuitive aspects of successful dividend investing. The companies with the most sustainable dividends often trade at what appear to be expensive valuations compared to flashier alternatives. Value investors love to criticize dividend stocks for being overpriced, but they're missing the point entirely. You're not just buying earnings when you purchase dividend aristocrats. You're buying decades of proven management execution and business model durability. Think of it like buying a Toyota versus a luxury sports car. The sports car might offer more excitement and better performance specifications, but the Toyota will probably still be running reliably 20 years from now with minimal maintenance costs. Dividend aristocrats are the Toyotas of the investment world. They might not generate the most exciting cocktail party conversations, but they'll keep delivering consistent returns long after those high-flying growth stocks have crashed and burned. The reality of building meaningful dividend income from $1 million portfolio requires patience, strategic thinking, and a willingness to accept that true financial independence takes time to achieve. It's not about finding secret high-yield investments or timing the market perfectly. It's about building a diversified portfolio of quality companies, reinvesting dividends during your accumulation years, and understanding the tax implications of different investment strategies. Most importantly, it requires abandoning the fantasy that dividend investing is a shortcut to easy money and embracing the reality that it's actually a methodical approach to building long-term wealth. But here's where most dividend investing advice becomes dangerously misleading, and it's something that could cost you decades of wealth building if you get it wrong. The financial media loves to showcase these cherry-picked success stories of people living lavishly off dividend income, but they conveniently leave out the most important part of the equation. These success stories almost always involve people who spent 20 to 30 years building their portfolios before they started relying on the income. The math is actually quite sobering when you break it down, honestly. If you're starting with that $1 million portfolio today and you need it to generate enough income to replace a $60,000 salary, you're not just facing a shortfall in current income. You're facing the reality that inflation will erode your purchasing power over time, meaning that even if you could somehow live on $34,000 today, you'll need progressively more income each year just to maintain the same standard of living. This is where the dividend growth component becomes absolutely critical, but it also reveals another surprising truth that most investors never consider. Even the most reliable dividend growers typically increase their payouts by only 3 to 5% annually. That barely keeps pace with historical inflation rates, which means your real purchasing power from dividends might not grow at all over time. Let me paint you a picture that might make this more concrete. Imagine you're 55 years old with that $1 million dividend portfolio generating $34,000 annually. You're thinking about early retirement, maybe planning to supplement this income with part-time work or some withdrawals from other accounts. Fast forward 15 years to age 70. Even if your dividend income has grown to $50,000 through consistent increases, inflation has probably reduced the purchasing power of that $50,000 to something equivalent to about $38,000 in today's dollars. So, after 15 years of dividend growth, you're actually worse off in real terms than when you started. This is the harsh mathematics that those dividend lifestyle blogs never want to discuss because it doesn't sell courses or generate affiliate commissions. But here's something that might genuinely surprise you about successful dividend investors. Most of them don't actually live off their dividends for the first decade or two of building their portfolios. Instead, they reinvest every single dividend payment back into purchasing more shares, creating what mathematicians call exponential growth rather than linear growth. This reinvestment strategy transforms the entire equation in ways that most people find difficult to visualize. Instead of that $34,000 going into your checking account each year, it automatically purchases more dividend-paying shares. Those new shares generate additional dividends, which purchase even more shares, creating a snowball effect that becomes increasingly powerful over time. The numbers on this are actually stunning when you run them over realistic time periods. That $1 million SCHD portfolio generating $34,000 in annual dividends if you reinvest those dividends for 10 years while the fund grows at historical rates becomes worth approximately $1.6 million. But more importantly, it's now generating about $54,000 in annual dividend income. So there you have it. The surprising truth about dividend income from $1 million isn't that it's impossible to achieve financial freedom through dividends. It's that the timeline is much longer and the strategy is much more complex than anyone wants to admit. Building meaningful dividend income requires patience, realistic expectations, and a willingness to reinvest for years before you start spending. If you found this breakdown helpful and want more honest takes on dividend investing without the fairy tales, make sure to subscribe and I'll see you in the next video.